What's better, getting $50 or getting $100 and giving 50 back? You may say, well, they're exactly the same.
Nope.
Daniel Kahneman will prove you wrong. People will almost always pick the first one and avoid any kind of loss. It seems like there are two types of people: successful investors that understand the stock market and time everything perfectly, and then there are those that are doomed to follow the crowd and make all kinds of mistakes. In reality, anyone can become a successful investor by applying a few basic principles, but our own psychology often gets in the way. Daniel Kahneman, the author of the bestseller Thinking Fast and Slow, is one of the founding fathers of behavioral finance. Being a psychologist rather than an economist allowed him to reconsider the traditional financial theory, which assumed that people are rational, thinking creatures with perfect self-control. Kahneman's impact on this area is so big that he was awarded a Nobel Prize in economics for the work he did with Amos Tversky back in the 70s, particularly in the areas of human judgment and decisions in uncertain situations. They demonstrated that our human nature gets in the way through lots of cognitive and emotional errors. Being aware of these pitfalls will help you become a better investor. So here are some of the main factors that affect our decisions, and the first one is overconfidence. Have you ever noticed how confident people tend to be about stocks, crypto, and the markets in general? It seems like everyone on the internet knows when the next crash is coming except you. Kahneman says that there are two types of confidence, one based on expertise and another one based on the stories we tell ourselves. So the judgments we make and the feelings of confidence we get are in response to the quality of a story we tell ourselves. According to research by Terry O'Dean, one of Daniel Kahneman's students, people trade too much. They have too many ideas, and acting on too many of them results in worse performance versus doing nothing. He analyzed the results of people buying and selling stocks on the same day. He found that on average, investors underperformed themselves by 3.4%. Which is a significant difference when doing nothing means you do better. So how coherent a story sounds is more important than the quality of the data in the story. And when we hear the story again and again and we repeat it ourselves, we become overly confident in our opinions and beliefs. It seems to be our way of dealing with the real uncertainty and risks we face. And this is something that even professional investors get. In fact, the top CFOs are usually more overly confident than others. And when we have too much confidence in our opinions and beliefs, you know what's going to happen. If the story you're telling yourself makes sense, then you feel confident. It has very little to do with the quality of the information. So what can you do as a beginner? Having investment goals and a plan is much more important than just buying and selling assets because you believe a story you're telling yourself about what's going to happen in the future. Don't trade too much and don't check stock prices all the time. By trading less and investing for the long term, you achieve a better result. Another thing that affects our decisions is loss aversion. So why do people buy and sell too much? Many people know that timing the market is a bad idea, but why do they do it anyway? Another key concept in behavioral finance is narrow framing. This means that people have a tendency to make decisions without considering the overall context of what they're doing. Kahneman explains that we have different brain circuits for immediate and delayed consequences. We put more emphasis on negative events than on positive events, on losses than on gains. And the possibility of a loss has a significant role in people's decisions. This results in loss aversion. Because investors like to give themselves pleasure and not pain, they focus too much on the price at which they bought a stock, which is a bad idea once again. As a result, they tend to sell their winning assets because they like the feeling that they've won, but they hold on to the losers because their position is down and they want to win. But this makes no sense in terms of a healthy portfolio because people end up with assets they don't want and get rid of the good ones. So it's great to think of your portfolio as a whole rather than individual stocks, etc. Which is why it's so crucial to have goals and a plan rather than acting on impulse. Learn about basic portfolio management and asset allocation, and once again, don't trade too much. Finally, let's talk about how people perceive the past with hindsight bias. When a surprising event happens, the surprise is very brief and then people are no longer surprised. And it's hard for us to reconstruct the way we saw the situation before the fact. Kahneman gives the example that if two soccer teams appear to be equally matched, but then one team beats the other one 5-0, many people are likely to convince themselves after the victory that they knew would happen all along. Why did they win? Because they're stronger. How do you know they're stronger? Because they won. Same goes for any unexpected event like Donald Trump's victory. It was very surprising at the beginning, but every day it's a little bit less surprising until it's not. A great example is the Great Recession in 2008. Michael Berry, the guy that predicted the crash, had a film made about him because he knew it would happen all along and put everything on the line and made $100 million for himself and $700 million for his investors by shorting the housing market. But Kahneman points out that many smart people did not anticipate the crash. So in reality, it wasn't as predictable as it appears now. It appears more predictable than it actually was. But what happens is first people tell themselves they knew something would happen, then they construct a story telling themselves it was inevitable and had to happen. This can even even distort people's memory to the point where they think they said it would happen. This gives us a feeling that the world makes sense, denying the real uncertainty and the number of irrational actions present in things like stock market movements. But in reality, a big financial event is a surprise to most people, and our whole life is made up of black swans, major events that nobody anticipated, except for Michael Burry. Speaking of investments, it's important to realize the markets are always going to be unpredictable. And if someone says they know what's going to happen, take that with a pinch of salt. It doesn't mean they're lying to you to sell their secret trading method. That person might have just constructed a story that makes sense that they tell themselves and everyone they know. So be prepared for random and unpleasant events. They're always going to happen, and they may actually be your biggest opportunities. Improve your investment knowledge, make a plan based on your personal goals, and stick to it. The reality is, successful investors are successful because they've been doing it for decades and they've seen a bunch of recessions and crises, but they've learned how to focus on their goals despite what others think and despite all the noise in the market. So all the best with your investments, and see you soon.